Hey everybody, Boris speaking Forex. Welcome to the weekly technicals for the euro dollar, dollar yen, and pound dollar, the majors for February 11th, February 15th, 2019. Range is about to burst. We are at some incredibly tight volatility spreads essentially in majors, especially in the yen, especially in the euro, coming up to some very key levels. And depending how which way we break is going to be, I think, a very telling and interesting move as far as the technicals go. For the euro, we still remain in this 15 to 13 range, but ever so close now to the 13 level as the news out of the Eurozone just continues to get more dour every day. We're at a point now where the French pulled their ambassador from Rome, which is just astounding if you think about this. This is kind of like pre-World War II type of tension that has happened amongst two of the biggest key economies within the Eurozone. So hardly a vote of confidence on the political front. The economic front still looks very lackluster. And the fact that global growth across the world has essentially dampened completely really puts a very serious question mark as to whether the ECB is following the proper policy. To add insult to injury, the German 10-year Bund now is 8 basis points, essentially in BOJ type of territory. We are now turning Japanese out of Germany. That is an incredibly low yield and a vote of absolutely no confidence in the growth of the Eurozone. And that is, of course, all just completely destroying the euro to the downside. Yet it continues to hold. That's the key thing. It just continues to hold the 13 handle for the time being against sort of all doubt. Similarly, against all doubt, the yen refuses to buckle. We have had the first losing week since the beginning of the year in equities. Dollar yen just has not been able to come off the 110 handle. This is sort of really a glass half empty, glass half full type of a look. We'll take a look at it. The volatility today was astounding. Astounding. I will show you the charts. It was a 20-point range. Outside of holidays, I've never seen a range in dollar yen this tight for a full 24-hour cycle. It's just incredible at how much equilibrium there is in the pair, which all of it suggests that we're going to tip one way or the other hardcore in the next couple of days. And the pound, of course, is just kind of free-flowing against the Brexit news. It did break the 30 handle. The market is becoming more and more disappointed with lack of progress, but still hopeful. This is the key thing. It's really impossible to handicap this trade in any meaningful fashion at this point. Technicals, the only thing that you can trust here is the fact technicals have not broken, and as long as they don't break, it's very hard to get short cable here with any serious amount of conviction. The calendar this week, or next week actually, is relatively quiet. We have a series of UK data, starting with, of course, the GDP numbers. The UK data is going to be horrible. There's just no doubt. We've had complete declines in PMIs, both on the services front and the manufacturing front. The critical question is the market going to care? The market, BOE has already warned about the fact that fourth quarter GDP is going to be considerably worse. I mean, I think the only thing that could really shock the market is if we go fully negative. If we go fully negative on GDP, maybe that'll be a wake-up call to the fact that when Brexit actually hits, we could be in serious contraction territory. But for now, it remains an open question. I do think a negative print in UK GDP, which is unlikely but possible, could be a very sharp drop in a pound. But still, at this point, it's all forward political trade, not backward economic trade as we go into the marketplace. CPI, RPI, we're bearish the data because there's just continued decline in BRC shop prices. Of course, also a very lackluster consumer environment, not going to be very supportive of any kind of high price pressures. Euro, the data on the industrial production and on CPI, we're actually mildly bullish. Bullish the euro. I'm sorry, the industrial production is to the euro. Mildly bullish the euro because there was less of a decline in industrial production and better French industrial production here. That's a minor report. It could just provide a modicum of support for the euro. U.S. CPI data as we go into the week should be looking a little bit better because we've had minor price increases in gas. Again, none of this is going to be material because it's a 210 versus 220 type of a print. It's not going to have any serious impact as we go forward. Into Thursday, Friday. Thursday, we have the German GDP, again negative because German GDP actually came in within a whisker, I think, of contraction. And on the US side, more PPI data, but really the good print, the interesting print, will be the retail sales. And that's going to be an interesting tell because it's really going to be a vote of confidence on the US consumer side. We don't have much of a view right now. Kathy is looking to see if we can update the CPI data, but the retail sales numbers, nobody's looking for a big bump. As a matter of fact, we're looking for a smaller rise than the month prior. And I think overall, the turbulence in the marketplace in December, along with the shutdown that occurred during that time, should be a pretty big dampener on retail sales. And I don't think it's going to be very productive for dollar yen at this point, or for the dollar period. And then finally into Friday, again, a modicum of just second tier data. Retail sales out of UK, is it going to really matter? Of course not. It's probably going to be lower than expected at this point. Consumer confidence, that's actually should be interesting because consumer confidence numbers were surprisingly weak. And a lot of people have made a very, very interesting observation that the drop between current expectations and future expectations, the gap, is one of the most startling declines, and also one of those type of very interesting, unique indicators that suggests possible recession or possible slowdown, because it's the future expectation component really coming down hard that essentially controls present spending. So need to watch that relationship very, very carefully. If we continue to see a widening gap, further deterioration in future expectations, I think the market is going to take that very badly into the close. So those are the major events. They're all essentially second-tier data. I think the UK data front of the week could be interesting only if it just simply shocks the market into possibly a negative reading. And that's pretty much as far as that goes. Now, looking at the charts, and this is really, I think, telling at just how tight. Let me get to the. Sorry, I'm going to go to the daily charts. I was looking at the 240s for a second. So you're looking at the euro here, and clearly you see a very clean pattern here that the 15 is a big resist. It's kind of like this wave that hits the ceiling at 15, comes back down, secondary wave. But conversely, the wave also hits support at the 13, comes back up. This is the third or the fourth time. And this is really a telling moment, right? So 13, I would say 1250, of course. This, we probe it to the downside, and every time we probe it to the downside, 1267 was the lows, 1267 is the lows. This is really going to be the terminal point. We take out the 1250s. That puts this double bottom into tested 1200s, and it becomes a much more dour construct for the euro. So this undulation that we've been having for the last 3 or 4 months of the 1513 range could break hard and break ugly all the way towards the 110. That's contingent on intrinsic flows in the eurozone. It's very much dependent. This is what I wanted to show you. This is just astounding when you look at this. Look at the 10-year German yield. That's not 86 basis points. That's 8.6 basis points. That, because this is to the third decimal point. That is literally no money for 10-year print. It's just astounding at how low that is, and why it certainly makes you understand why the euro is under so much pressure. But this is the thing: as much pressure as it is under, the moves back up here were all functions of what I would call anti-dollar flows. The question is, does the dollar get any kind of support here? Because for the euro to really weaken hard, we got to see some flows into the dollar. I think the jury's still out, but we're certainly at a very dangerous point. A break of the 1260, basically the 1250 level, really creates a much more negative construct for the euro at this point. On the other hand, if we hold, and more importantly, not only do we hold, would I want to try to buy the dip here? Only if we hold and turn green on the day. At that point, you could definitely take a punt. Right now, you just simply have to watch how the market reacts at around these levels, because this is going to be a very telling point into the week. Cable got weaker. No surprise here. But what I think is relatively bullish is this recovery of the BOE. The fact that post-BOE, the market bought this. it's feeling mildly confident that something is going to get done. You sort of look at the full development since the failure of the vote, which is right over here, and since the beginning of the year. So this is the flash crash, the failure of the vote. What you see consistently here is these massive doji buy-ups, market just simply buying every panic selling trade, and for the time being, that's positive. Having said this, this to me is a very key tell. We close below 28.50. That completely changes, I think, the technical structure here. We go from a mildly bullish buy up the doji structure to essentially a complete distribution of the 132s, which is going to be a triple top formation. We close below here. That now turns into essentially a very distributive top with the potential down to the 26s. We're coming down to the wire. There's no resolution, and there seems to be no political will to want to do a second referendum. So it's almost like Britain is just walking itself off a cliff. The market's still betting that saner minds will prevail, but the argument is getting weaker by the day. And I think the technical tell of the loss of faith will be a break of this low. Breaking and close below this low will be a signal the market is losing all faith in a Brexit compromise, and then we could it's a one-way ride all the way down to perhaps the fat finger lows. And then this is, I think, the most interesting or frustrating chart, depending on your point of view. This is an astoundingly low volatility signature, even for dollar yen. I mean, dollar yen is notoriously a low volatility trade, but I don't think if you look around, there's just very little historical record here where you have a couple of days, 3 at most, where you have low volatility. We had 4 days where the average true range, I think, was less than 40 points. And today was just really a day for the ages. High 89, low 64. It's not even it's barely a 25-point range. It's like a quarter. It's insanely low for a full 24-hour range, even for this particular pair. I think Christmas Eve it does bigger range than this type of trade. More importantly, and this is where it gets very, very tricky. You are seeing certainly a loss of momentum. RSI, starting to curl over, and this 110 really acting like a big resist point. But having said this, though, at the same time, it's not buckling under. Every time they try to bring it down, there's clearly a bid underneath this thing. Until this bid disappears, until you see some evidence that the buyers finally go away, I feel it's almost like a trap to try to short this. I mean, it's a small trap. You can take a punt here, but it's one of those kind of punts that could just viciously go up against you if suddenly we develop a short covering squeeze here. A short covering squeeze here that clears the 1016, 1020 level, opens up the round all the way out towards 111, 112. That would be shockingly surprising, I think, to the market, which is seeing a lot of dollar weakness. But from a technical point of view, it'd be perfectly natural trade. All I'm saying is, if you're going to trade this, you got to trade with a 1025 stop. It's a small 50-point risk, and maybe the avalanche will finally fall. But what you really want to see, honestly, if you want to have some confidence in this trade, is let it close below the 20 SMA. Let it give up the 20 SMA. Then at least we have a clean, clear, confirmed loss of momentum. Then that top really looks a little bit more formidable, and we could probably drift all the way down towards the 108 level. So very, very tough trade, requires a lot of patience, but depending how you tactically position yourself, could be some very interesting profitable moves here into the week ahead. Wish you guys the best luck, the best trading. Boris Schlossberg, over and out.